All right, I'm going to start here. My name is Dan Betancourt. I'm President and CEO of Community First Fund. Welcome to this panel where we're going to discuss financing for entrepreneurs of color. I am going to serve as your moderator today, and also, I guess, pitching in as a panel member as well. But we have an esteemed group of panel members. I'm very honored to be here today. They have a long bio, but I will let you know that you can Google their names and find a whole lot more information. But I do just want to let you know very briefly who the three panel members are with me. And the first is Melissa Bradley. And by the way, all three panel members are known nationally and have a long, as I said, long track record. But Melissa is a founder of 1863 Ventures. Her main focus is on racial equity nationally. I know she helped a lot of entrepreneurs during COVID. She's also co-founder with a very good friend of mine, Nancy Negron. She's co-founder with her of Eureka, who provides technical assistance training and also racial equity support for entrepreneurs. And there were thousands during COVID. She'll talk more about that. She's also a professor at Georgetown. And of course, my good friend, Clarence Campbell. I don't need to look down, Clarence, because you're director of lending at a Black-led CDFI out of California. And of course, that's Lendistry. If you don't know Lendistry, you should know them. They're fintech, they're a CDFI, and they got billions of dollars out during COVID. And you'll hear from Clarence. And of course, finally, Dr. Del Gines. I just met him recently, and he works for the Fed of Kansas City, done a lot of research around racial equity, particularly around for entrepreneurs. Recently, he did a study on Black women entrepreneurs, and I can just say more about the three of you. So let's go ahead and get started. I think our challenge is going to be, we only have, I guess now, 35 minutes, and we got a number of questions here. So without further ado, let's go ahead and get started. First, let me just say, we all know we had, and I love the way Del framed it, we had the summer of George Floyd, summer of protest, summer of an awakening. We were all wondering whether it's going to be a moment or a movement. And so that's sort of where we're coming in here. And so while we've been working on racial equity all these years, I think some folks are coming around to it, but we're also seeing resistance across the country. So, but the main focus here we're talking about is capital and support for entrepreneurs. And so my first question will be just a little bit of framing on that for you, Melissa and Del, is we all know PPP. We know we didn't have to wait long to see the autopsy. There was the factual discrimination that the banks focus on their clients, and that money did not get out to entrepreneurs of color, did not get out to mom and pop businesses. In fact, Lendistry's whole model was getting money out. But for you, Del and Melissa, we'll start with Melissa. Is this a one-time phenomenon, or do we think that banking will change? And what did it learn? You know, what did we all learn in terms of coming out of this COVID? Do we think the bank is just going to bounce right back to where it was, or do we think that this moment can move it, turn into something more permanent for entrepreneurs of color?
Well, first of all, thank you for having me. And I think it's a complicated question, but my hope is that this is not just a moment, but it's a movement. I had the privilege to serve in Treasury Department as a regulator, particularly of Black banks. And the problems that we saw were not new. I think what was new is that the world got to see it. The world got to see the distribution problems, the friction in the marketplace, the racism and underwriting, the skepticism about our ability to run a business. And it was now just amplified, unfortunately, for all the wrong reasons. I think once you saw that there was some adjustments on behalf of policy to make sure that we weren't just using traditional banks where many entrepreneurs, particularly of color, do not have strong relationships for a variety of reasons, that there was a need to really look at where do we bank, who do we trust, and to Del's great work, we have an ecosystem that supports us. We have a multitude of relationships that are required, and oftentimes because of capital constraints or capital requirements, we also have multiple relationships. And so my hope is that as somebody who invests and work with entrepreneurs, that there is a learning both at the federal level and at the local and state levels around where there's market opportunity, what needs to be done to reduce the friction, and how do you really open up the hose, so to speak, in a good way, so that the money actually flows because we are viable businesses. I think from a policy perspective, there is a real opportunity for SBA and Treasury and EDA and all of these agencies to really think about how do we understand who are lenders in the communities that I care about. They are not necessarily banks, they are nonprofit lenders, they are folks like Lendistry, they are cousins, they are friends, they are fintech platforms. And I think we've got to acknowledge the fact that we all do not bank the same, and the trajectory for an entrepreneur is not the same. And we need to figure out how do we better support the trajectory of entrepreneurs of color for sure.
Yeah, I mean, I agree with what she said. Let me make this clear. The views in this presentation do not necessarily represent the views of the Federal Reserve Bank of Kansas City, the Federal Reserve System. So when you look at the concept of what is happening in the banking industry, you've seen this massive consolidation. I mean, I think we're down to like 19 Black banks total. And at their peak in the early 1900s, there was like 150 to 180. I can't remember off the top of my head. And this is something that's afflicted the whole industry. Most of these major banks who hold the majority of the assets essentially are controlling a lot of large percentage of the industry. And so they're based upon every quarter I got to report profits to, my shareholders. So it creates a level of incentives from a profit motivation and also from a regulatory process that we have to begin to ask ourselves why what happened in the pandemic in relation to small borrowers and borrowers of color happened. And I argue that a lot of it is because of the structure of the banking industry itself, the way that it's regulated, and the hyper consolidation in the industry. And per usual, what you tend to see happen when major corporations are doing anything is they want their preferred customer. And unfortunately, many Black and brown businesses were not that. And so the incentive structure for the banks was to do exactly what they did, especially in the first round of PPP. But what it also did, because remember, I said it was I called it social justice summer, and from the pandemic side of it. And then you saw this emergent, issues around small business. What I think, if anything, it did was it showcased for the world, for the nation, for sure, the cracks and the fragility within I'm just going to call it the financing ecosystem for BIPOC entrepreneurs. I mean, things like, you hear people. So I'm going to put a couple links in the chat for you all, but we do an annual small business credit survey, and consistently borrowers of color will tell you that they don't even bother to apply, even if they potentially could get a loan, because they're discouraged borrowers. So what does that tell you? Then it's exacerbated about other things, because it's not all the financial institutions' fault. We have structural problems in the way we educate entrepreneurs that end up reflected also in the credit market, where you got folks that don't have taxes. They don't file their tax returns, or they do cash-based businesses. So then when they were expected to go and do that with their banker, if they could get a banker on board with it, they didn't have the documentation or the technical assistance skills. So we have a tremendous opportunity going forward to use that as a learning platform, learning basis for us on how we can better, engage our entrepreneurs. And I do want to amplify one thing Melissa talked about, which is we all bank differently. And I have consistently had a problem with what I call the hegemonic perception that everybody needs to be banked. We say banked and unbanked, like there's only two ways of doing financial transactions, which ignores people like Clarence, who's going to talk in a second about what he's doing, and all these other things we could be doing to resource our BIPOC entrepreneurs.
And just continuing on that topic, Del, entrepreneurs of color are starting their business at a faster rate than their counterparts and their white counterparts. Yet there's significantly less capital. You just talked about that a few moments ago. How should that disparity be addressed, and how do we close that gap?
Well, I think, it depends on how we're going to look at the challenge. So when I wrote the Black Women Startups report, one of the things that came out that was interesting was actually Black women and white women start their businesses with the same amount of general financing in their capital stack. Like 50% of all Black women started their business with friends, family, and fools, the 3 Fs we call it in the credit market. White women did the same. Now, what do we know though? We know that the white people tend to have 20 times more wealth than Black people. So you have a household income, a multi-generational wealth issue that bleeds into the conversation, which is call it a community infrastructure problem driven by historical redlining and other forms of systemic racism and educational gaps. But then more practically speaking, I think we don't do a good job of starting with the end in mind. Like, if we were gonna, here's what I tend to ask people. I ask it about every kind of system. If we were gonna re-envision the credit system today without any prior knowledge of what came before, all of us had to get in the room and say, we're gonna build a whole new credit and capital access system without thinking of anything that happened in the past. Would it look like what we have today? And if people say no, then you know that it's a legacy issue, that it's a pathway dependency issue, that people are just relying on these old systems, even if they know that they're inefficient. So I think that's where people like Clarence and others come in, who are saying, we can find alternative solutions, but we need to be resourced on to be able to get that capital out, to look at different ways, like Melissa's doing with the equity side, all of these different kind of things. The challenge is we haven't been able to scale them to a critical mass so that they can be disruptive in terms of how they address the credit concerns of BIPOC entrepreneurs.
And Clarence, I mean, you heard Del say that, these entrepreneurs are starting with their family and friends and they're believers. But we know that entrepreneurs of color, capital is important, but preparation, right? If you have multi-generational businesses supporting a new business coming up, that's one thing, but a lot of entrepreneurs of color are just coming up. So how do they prepare themselves, and and where should they go for capital? I mean, you certainly are CDFI, but also a fintech at the same time. And so what are the opportunities for them, and how do they prepare for that?
Yeah, no, thanks, Dan. And I want to piggyback on something that Del said, which I think is so critical. And that really is about supporting alternative lenders in terms of getting capital out, right? And creating a system that really makes it more advantageous to drive collaboration versus these silos. And so I think that is a huge opportunity for us. And speaking as a former banker, certainly understand the impact of that. But as you think about, what our businesses need to do, there are a couple things. One is, as you think about the services that you get through banks, it's not just the capital disbursement. It's also the depository services that you get. It's also some of the other ancillary services that you get that allows you to really effectively manage and scale your business. And one of the things I always stress to small business owners is that you should start to ensure that you have a really strong team. Every small business owner should have a team. And one of the things we've seen historically in the underserved communities is that those communities aren't laden with professional services, right? So it's tougher to find your legal services. It's tougher to find bankers that you can build relationships with. It's tougher to find the accounting services, which, as you all shared, was such a huge impact with PPP, right? So many businesses were left out because they didn't have the knowledge and those services. So I think one is really seeking that professional guidance to help you grow your business. And that knowledge is a gap that we've had in our community for a very long time, but building a strong team. I think the other piece is recognizing that things will never return to where they were pre-pandemic, right? The impact and the need to really pivot and understand how businesses is going to continue to be affected, and how you need to change. Supply chain issues that you have out there, the need to really change your marketing strategies out there as well. And so really being able to develop a strong plan for pivot. And then the biggest thing, whenever you're looking to seek capital from whichever source that you're seeking it from, is being able to effectively articulate how it's going to impact your business. So again, really taking the time to really look at the plans for your business to understand how that capital that you're looking for is going to have the greatest impact.
And Melissa, with the emergence of fintechs like Lendistry and others, and there's a lot of more attention paid to CDFIs and crowdfunding and other sources helping businesses owned by people of color. What should we expect from banks and other traditional sources to fulfill the needs of businesses owned by people of color?
Well, I'll tell you what we're seeing, and then hopefully that will inspire them. because I can only hope they begin to make some changes. When we think about PPP and how we started this conversation, we know that the denial rates for Black entrepreneurs was over 65%. And that's not a small feat. And oftentimes, in all fairness, it was due to some paperwork and some other challenges that I think could have easily been recognized. But in that sense of urgency, they were unable to go. So let me just level set. There were probably some hurdles in getting them across. But when we did see entrepreneurs apply, we know that about 25% of them who applied for PPP did so through fintech lenders. And I think it's less about the structure of the institution. So I'm not going to get into a debate or banks better than CDFIs and vice versa. I think it is about what was already shared with Clarence around, is the institution ready to receive the entrepreneur and authentically help them move along? And have we reduced the friction and the inherent fear and trepidation that comes when approaching any of an institution? Because even myself, as someone who is, thank God, done well, every time I walk in a bank, my skin just crawls. It's almost like me, a black woman, seeing a police officer. Like, there's just some general institutional forces that just cause us to know this is not a safe space, and they do not have my best interest in mind. And so I do think that these statistics, albeit them small, but we know that many of these Black entrepreneurs, and ones that I know, tried to actually go to banks, but they were turned down, and more than twice the rate by banks they were fintech companies. And I think that's for three reasons I think are relevant for banks moving forward. One is that they have, I won't say mastered, but they have certainly fundamentally improved the underwriting process. And I've seen this with industry and others, so I'm not going to, again, play the institutional game. But I think if we were able to understand that there is a cultural component, a social component, a financial component, and a business component around how you underwrite, people are able to make better decisions. And when you have a collection of data, you can then make estimates beyond your superficial judgments of who I look like, what I look like, and what's my zip code. I think that is fundamentally important if banks want to be in this space. I think the second thing that needs to happen is that many fintech firms, and certainly CDFIs, recognize the power of Black and brown entrepreneurs. Let's just laser focus in. If people understand, there's an AEO report, part of their Tapestry program, that said, if Black businesses had been invested on par with their white peers, we'd have over 1 million more businesses and over 900 million more in GDP. So it is actually an opportunity cost for banks that pride themselves on creating wealth, that if you continue to ignore us, then you are actually missing out on potential contribution, as Black entrepreneurs contribute 10% year over year to GDP. So I think that they need to understand and really spend time researching and talking to folks in this call and others around what is the data that drives the fact that this is a missed opportunity by not investing us, further supported by the $16 trillion of the cost of racism. And then I think the third thing that banks need to understand is that if they want to be relevant, their inherent changes around where they sit, how decisions are made, there has to be some culture changes. As a former regulator, you have to have decisions based locally. Part of what's beautiful about lenders is they get you a decision soon. I think sometimes we're less concerned about a yes or no, but you are holding up our business because we've had to overcome the fear even getting to you, and we're asking for money tomorrow that we needed a week ago. And again, that's just part of the larger systemic racist structure that we sit in terms of our lack of access to financial capital, social capital, and other things that we need to successfully grow our business. So I'll end this by saying I would like to be optimistic about banks. But I think at this point in time, what they should know is that folks who look like me are agnostic around institution and brand. What we care about is the people who are willing to meet us where we are, that they are equally invested in where we're trying to go, that they are mission and financially aligned with our goals and objectives, and they are culturally competent in being able to support our vision and our mission.
So Clarence, I think Melissa laid the case for, CDFIs and companies like yours clearly see the power of Black and brown entrepreneurs. Is banking going to change its ways to reach this market? I mean, what are your thoughts around this topic?
Yeah, no, I think that's a really good question. And I do think that banks are ever seeing the opportunity for collaboration. As you begin to think about how that gap will widen, and I believe the gap will continue to widen from the ability of the banks to disperse capital, I think it really drives the opportunity to partner with organizations, CDFIs. I think creating opportunities in space where it's more advantageous for financial institutions to do that, it's a win all the way around. And so, I think as you start to think about those pieces, I think that there's an opportunity there. When you think about Lendistry and what we do, our business is built on collaboration. So we partner with a number of banks to really provide capital and support small businesses. We partner with other organizations. It's really more about how do we get the capital out versus who's getting the capital out. And so, building strategies, and Melissa talked about something I think that's very, very important, and it really is understanding how to drive that experience with customers. In many cases, a no is a no, but it's even worse if it's taking you 45 or 60 days to get to the no. And so being able to drive, processes that allow us to drive and give guidance and answers faster are important. But I think the other piece is that, when you think about CDFIs, and one of the things that we do, we're mission-based organizations. We're mission-driven. Our focus is around supporting the underserved community. So it's not just about getting capital out, it's also about providing education. Because as I shared earlier, unfortunately, there's been a gap in our communities, a knowledge gap. And so in many cases, it's not that the business can't be funded, it may just not be able to be funded at that time. And so it's really around helping businesses develop plans so they can properly scale and grow. So I think that's the case for banks continuing and looking for ways, exploring ways to collaborate with CDFIs to disperse capital and support small businesses.
Clarence. Del, you've done a lot of research around this, but what does the future hold for funding for entrepreneurs of color? And in particular, what are the trends and opportunities you see for business owners of color? And what's that profile look like in accessing funding?
Well, let me level set. The reason that I talk about an ecosystem is because you cannot analyze any of these things in isolation of the other. So human capital drives financial capital opportunities, drives social capital, vice versa, all the way around. Culture drives other aspects of how we do business, et cetera. Policy, of course, and our infrastructure, the big six that we talk about in ecosystems. And the problem with examining them in isolation is that you kind of overinflate, in many instances, the thing you're focusing on. Like, I've always thought we overinflated access to capital. I quite frankly have. Like, as a former business banker and microlender, I ask people the question, would you rather give somebody with no entrepreneurial talent at all $10,000? Or would you rather give somebody with high entrepreneurial talent $5,000? And which one do you think would be better, more productive with that money? And so it's both and. And when we talk about access to capital, all else equal, we are discriminated against in the market. The too much data, is shown, it's just clear. And do I feel like that's going to resolve itself anytime soon? Absolutely not. And so then it requires us to look at other potential solutions to offset what we know is systemic discrimination and bias in the banking industry, which is how do we do parafinancial financial lending institutions, could be CDFIs, others. Can we look at fintech in the alternative role they play, but do it and de-risk fintech because of the lack of, in many cases, transparency, inflated pricing, and other things that we know go on there. I think it's, as an evolving industry, I think so, because if you look at the small business credit report survey that we do, one of the things it shows is BIPOC people consistently have the best outcomes with small banks. The very same institutions that are getting consolidated into big banks. So, but why small banks? So, Melissa, you were an old school regulator. Clarence, I think you maybe mentioned we're in banking before. I was in banking back when they shifted to this, hey, let's send everybody to the phone for customer service and run everything through a centralized standard underwriting. And I'm sitting here in the Black community, almost getting fired because I told my boss, I'm like, I have to do 4 times the loan applications to get 1/4 the approval rate, but I'm judged the same as everybody else in my hood. And I said, how does this make sense to me? And so we have to just say that we can, on the margins, I think, change some of the banking industry. The lowest hanging fruit to me for the banking industry, and I'm talking mostly big banks, is by having dedicated community engagement with folks so that the relationships are driven, and with other resource providers, so that if they say no, they're not just telling them no like you all said, but they're sending them to an industry They're sending them to a Melissa if it's equity-based or other forms. They're sending them to other people that can help them get to a yes, either in that market or other places. But I think for us, I think we really need to step back at the community level. We need more philanthropic engagement on this issue. We need more government engagement on this issue. Look at the dollars coming down through the ARP funds and SSBCI. Like, my community has an unprecedented opportunity in Omaha to get $100 million into our Black community. This has never been done before. How much of that is going to go into financing opportunities? Are we advocating for that? So putting it all on the backs of banks, I just don't think we're going to have as much traction as if we look at it more broadly and look at diversifying the potential funding stack versus over relying on one institution, which is heavily regulated, heavily profit motivated, and heavily oligarchical. I'll leave it at that.
Thank you, Del. Clarence, as a lender, how does your work inform the work of other lenders to help these entrepreneurs of color that we're talking about here?
Yeah, and I think that's one of the things that's really unique about Lendistry, is that we're a CDFI, but we're the only fintech CDFI in the country. And so as you begin to think about that, one of the big things that we've done is really focus on our technology and really showing the impact of how technology can support on a broader scale. And so we've done that a couple of ways, not just with our traditional lending platform, but it was our technology that really allowed us to have a tremendous impact with PPP and really getting the capital to the communities needed. In this past round of PPP, we supported over 200,000 customers and dispersed almost $4 billion in capital. And so it's all technologically driven. And so as you think about that technology being able to partner and collaborate with other organizations to support those communities and have a more broader national impact, I think that's one of the things that we've done. I think the other is really, as we talked about partnerships with other financial institutions and talking about the importance of changing regulation that would really drive partnering with banks and CDFIs and making it more advantageous, we've been able to show through that collective impact how we can support those underserved communities. And so, following and continuing on that path, I think that's the way that we have the tremendous impact. I agree with what Del said. It's not just a one-dimensional. It really is looking at it from a number of avenues, but really it's going to take a number of things for us to really change what's happened and occurred for so many years. And so, again, that collective impact I think is really good. And the work that we're doing, I think, helps to really show what can be done on a broader scale. It's just a matter of time before there's another Lendistry or several other Lendistries that's having a greater impact throughout the country.
And this moment we've been talking about, Melissa, how can we make this into a more permanent change in the bank system? And what are your thoughts around that?
But there's a couple of ways. I think banks operate in two ways, right? They think about their customers and they think about who regulates them and who's in charge and who controls the purse strings. So I think from a consumer perspective, I think one, we need to demand more. I think if you are banking somewhere, we need to literally go in, understand how they operate, and continue to push the envelope. And I know it seems like a lot, entrepreneurs got enough to do, but I think really push the envelope with your local folks and help them understand what it is you're going through and give them a different picture and story that they can keep in their mind. I think the other piece is advocacy. Right? We need to go and think about who owns these banks. They all have board of directors. The information is very transparent. And we need to do what everybody else does and use social capital to start making some phone calls and saying what's going on. I think the other piece is we need to really continue to push on data. Kaufman and MacArthur and many others have continued to do research to just really change that narrative. 3 years ago, I did research that showed that Black entrepreneurs spend $250,000 more than their white peers to start the same exact business because of direct and indirect costs. And one of those was the discrimination that's allowable in the banking structure, but how they would still go on to be very successful. The average duration of Black Black entrepreneurs that we've just pulled over 1,000 is about 8.3 years, which means they've already surpassed the 50% failure rate that most other businesses, irrespective of race and gender, fail. Most businesses fail within 5 years, half of them. We're surviving longer. So I think we need that ongoing kind of data around our viability, around how we operate, around our financial needs, so that people can have much larger strategic conversations and then point to anecdotal scenarios, because this is what happened in the branch, or this is what happened when I spoke to somebody. And then I think on the policy side, there's a lot of work to be done on the policy side. I will say, while I completely appreciate what the SBA Administrator Isabel is trying to do, I worry that the SBA is trying to become a direct lender. We don't need more lenders. We welcome them if they want to come in the space. Don't get me wrong, good for them. It could have some longitudinal impacts, but it is not for lack of choice. It is because of lack of understanding and culturally competent systems by which we can access the capital. And so I think that we need to have regulators do more. Having done CRA lending, I think that has become respectfully a lackadaisical exercise. I think we are not always looking at the right things. I think we were looking to check a box of whether they did it or did not, and not necessarily the quality or the volume based on what demand was. And so I think there's some modernization or updating around what that can be. And I think that the larger regulators, before banks are even incorporated, they seek to get charters or make adjustments, that there needs to be a real look at what is their opportunity to be able to solve the racial wealth gaps in the communities that they so choose to live. I think CRA intended that, but it sure has a long way to go and oftentimes is not well enforced. And I think we need that carrot and stick to get institutions to do well. And then the final thing I think coincides is where we have data. I mean, we have data in the private sector that says that when women or people of color on the board, returns go up. That when you invest in certain demographics, returns go up. We need analogous data, because let's be honest, if you're on a bank board, you care about money. This is not about subsidy. This is not about philanthropy. This is how do we actually improve your bottom line, because diversification of any portfolio is critical to the success of ROI. We just have not had the right spokespeople or the right proxy or the right data to demonstrate that investing in us actually is going to generate better return, both in terms of just marketing efforts, consumer, et cetera. If you can do for us, you can do for darn near anybody. But we're actually building viable businesses, and there's certainly enough data around that, and that we are being locked out of the capital markets because of that. And the last thing I'll say, it's been very frustrating post George Floyd that everybody has gotten a conscience that there are lots of additional capital markets opening around trying to get us on boards, or the NASDAQs or other, thinking about how do we do more downstream investing. If we don't solve this problem, and it truly lies right here with banks and the lack of friends and family, we're really going to miss out on some of those larger opportunities. And as an investor in the space and as an investor in the capital market, that's disappointing to me, because I'm allowing other people's racism and bias to determine what is my ultimate profit potential.
Thank you. And we're coming up with a couple of minutes left here. So Clarence, we know that many entrepreneurs reimagine their business. They pivoted into growing their business in a different way, whether it was through technology or maybe really scaled up carry out, or all the things that entrepreneurs did. Do you see some more long-term impacts from the pandemic on these businesses or opportunities?
Yeah, and I think that's a really good question, Dan. You know, as we think about the pivot, and I shared earlier, you know, I think we will forever be changed in terms of the way business is done and the way business operates. And I think that those businesses that are not able to recognize this opportunity and pivot are going to struggle. You know, as you begin to think about just to think about what we're doing right now. We're having a conference via Zoom. And so businesses that have not been able to pivot in terms of how to connect with their clients, their partners, you name it, during this time frame is going to struggle. They're going to struggle because things will change going forward. And while there's not, you know, no substitution for being face to face and would love to be there with you, we have an opportunity to reach a broader scale with technology. So I think first and foremost, businesses that don't recognize their opportunity in this space to pivot are going to struggle and be impacted. I think the other piece is, as we talked about, is really around financials. One of the challenges that we see as lenders is is really the ability for business owners to provide the proper financial documentation needed to underwrite a loan. And let me just say, speak on behalf of a lender, that the primary goal when you extend a loan is to be repaid. And as a CDFI, as a responsible lender, we have a fiduciary responsibility to ensure that we're not only providing capital that's good for the business, our business, but also protecting those businesses in some cases from themselves. Because in some cases, a business may not be ready to accept capital. So, I think it's really important that businesses are able to really identify that opportunity where it exists to provide greater financial documentation, structure of your organization, so that you put yourself in a position to be able to go through an underwriting process. That's something I think we certainly need to look at guidelines and how we identify and connect with businesses, but there still has to be a responsible underwriting process as it relates to lenders. And that's one of the big things that we've seen during this pandemic, is that so many businesses were not prepared. And so what can we do at this point to ensure that they are to receive capital and properly leverage that capital?
Thank you, Clarence. And let me, on behalf of the folks here listening today and listening in the future, I want to thank you, Del, from the Fed, Melissa, from your advocacy on racial equity and your work at Georgetown and other places, and Clarence, you're a leader in the CDFI, but also the finance world and fintech world. So thank you for each of you. It's been enjoyable for me, and it's a wonderful, provocative discussion. I knew that we were going to have that. So thank you for bringing your A game and those that were listening today. Thanks again, guys. Talk to you soon. Bye.
So as we transition, we will prepare for part 2, which is scheduled to start at 1:45.
Thanks, Dan. So our speakers and facilitators for this afternoon, could you all just turn on your cameras and unmute yourselves for a minute, just so we can check in on audio and video really quickly?
Can you hear me?
Yep.
Okay.
John Kaler here.
Ron Williford.
Maria Sauerberg.
Yeah, this
Hi.
is Boy.
Harry Menace.
Good to see everybody. And I think David Sims, I saw David. David, are you
David
still
was
with
on the
us?
list, yeah.
Looks like maybe he isn't at his computer at the moment. He's on the screen, but still muted and camera off for the moment.
I'm here. I'm multitasking, everybody. Hi.
Hi,
You're
David.
a working businessman. Hey, David.
How are you?
Doing good.
Good. So did I miss something? Because I had it on mute for a quick second.
No,
while the
well,
phone rang.
we still are transitioning to part 2. We have 3 minutes before we
Okay.
start.
Okay. Hi, Arthur.
David, how are you? I'm not surprised you're multitasking. It's good.
Well, I've got a little mini empire to run. I've got to take my mini empire to a medium empire.
I hear you.
Yep. How you been?
Good, man. It's busy.
Okay.
Need to catch up, but it's been busy.
Okay.
I'm gonna just put on some of our announcement slides and play some music as we wait to get started again.
In my bed, it's so damn hot in here. I got your message read. They tattletale like feds. Just wanna be your friend and go downtown in the evening. Sharing secrets, I promise I'll keep. Let's just stay inside my vehicle. I can drive wherever. Let's go. Your smile is my antidote. Your smile is my antidote. Let's just stay inside my vehicle. I can drive wherever. Let's go. Your smile is my antidote. Your smile is my antidote. Riding through the city light. We gon' rob a bank tonight. Like we ain't got work tonight. I got angels on my side. They ride or die. So what I'm saying will be just fine. So what you mean will be alright. So what you saying? So what you saying will be just fine. So sweet like Krispy Kreme, so smooth like Mr. Softee. Come down my street, please. I got cash money. Let's just stay inside my vehicle. I can drive wherever. Let's go. Your smile is my antidote. Your smile is my antidote. Let's just stay inside my vehicle. I can drive wherever. Let's go. Your smile is my antidote. Your smile is my antidote. I don't play the keys like Alicia, but I rock the boat like Aaliyah. Of course I'ma charge for a feature. I don't even know, yeah. All this is musical theater. With all this drama in my life, I don't need that. You could take that back. Oh, you could take that back.
Welcome to this part 2 of what the future holds for funding entrepreneurs of color. I'm Pam Rich-Wheeler. I'll be your host for part 2. And just want to say it was such an excellent discussion for part 1 with our elite panel of local and national small business thought leaders who shared with us and gave us insights on the trends that are occurring around the funding landscape, and also helped us to position ourselves in this market for the ever-changing economy. In part 2, you will receive information from another distinguished panel of CDFIs and entrepreneurs who will share their personal experience and their funding ideas to see their dreams come to reality. So what I'd like to do right now is just briefly state who's on the panel, and then our 2 facilitators will take over from there. First, we have Arthur Jimenez, who is the Director of Business Development with the Philadelphia Industrial Development Corporation, otherwise known as PIDC. Secondly, we have Earl Boyd, who is the Director of Entrepreneurial Services at EntrepreneurWorks. Next, we have Maria Sorbier, who's an RA and Senior VP of Development with Mosaic. And then we have another business owner who is David Sims. He's the proprietor and artist with Eatable Delights Catering. And then our facilitators will be John Kaler, who's also the a Business Center board member and president of Prospect Productions, a video, photo, media, and web design company. And lastly, we have Ron Williford, who's also a Business Center board member and president, and the president.
Whatever basket you choose, we need roles
of.
too.
Can you
Always just
mute
include
yourself,
roles.
please, David?
No, I know I've seen it, but
We're going to ask, thank you. And as I was saying, Ron Williford is the board president with the Business Center, and he's also the president of Philadelphia Financial Consultants, LLC. And again, I'm Pam Rich Wheeler with the Business Center, where our mission is to equip businesses with the tools they need to start, sustain, and expand their operations. Without further ado, before I hand it over to our facilitators, I would like to thank PIDC and also recognize the other hosts for today, which include the Philadelphia Department of Commerce, Community College of Philadelphia, Power Up Your Business, Temple University Small Business Development Center, NextFab, PIDC, SCORE, and the Business Center. I'm going to hand it now over to Ron Williford and John Kaler to facilitate our discussion for today.
All right, great. Thank you and hello, everyone. I'm going to start with a series of questions that we'd like to ask our participants. The first question is, why did you choose PIDC as your lender?
I can dive in there. But PIDC has been amazing to work with. You know, I work for Mosaic, and, you know, my background is in real estate development, but social impact, community-driven real estate development, which is a high-risk place to be. And so we were certainly doing projects where quickly we would develop a gap, and a traditional lender wasn't able to step into those shoes. But PIDC had sort of a, you know, a mission alignment with us, where they want to see growth, you know, want to drive growth in neighborhoods. And so they were willing to come into a higher risk scenario on several of our projects, where maybe, you know, we were going to have to lean in with our commercial tenants in those developments, you know, that they weren't credit tenants. We were going to have to lean into the TI. We were going to need to lean into special leasing with them. And PIDC showed a level of flexibility and common interests with a group like ours, where, you know, maybe the IRR isn't the highest, or is, you know, of course we want a return on our projects, but, you know, the mission-driven side and the social impact side was something that PIDC also wanted to see. So it made them have an interest and an ability to see past some of the high risk things that were going on in projects like ours.
David, what about your experience?
Okay, so my experience of why I chose PIDC, I really hadn't gotten very familiar with the lending process, being as though that this was the first commercial property that I had purchased. So it was between PIDC and United Bank. The reason that I chose, and then I want to talk a little bit further about the relationship, because that's more important now than the reason. The reason that I chose PIDC and what they did for me was, I always say, they put me in the shower, they lathered me up real well, and then they took the hose and they squirted me down and got all the dirt and the residue off of that. So when I went to PIDC, I had 14 outstanding judgments, some of which I know about, some I didn't, and they went all the way back to 2005. So my first question in 2019 was, well, I thought they were only supposed to go back 7 years. And they were like, no, that's not how it goes for commercial lending. So to go to PIDC and for them to show me what needed to be done, for them to clean me all up real nice and get me prepared for what happens. I don't think that commercial lenders such as, and I'm just going to throw out there Wells Fargo, because that's who I have been banking with for many years. I don't think that that's what they do. talking about what now is a little bit more important is the relationship that I built with PIDC is not only have I had the opportunity to work with them and go into the different classes and things like that and showing me what needs to be done, but I've had some interpersonal relationships that I've benefited from, like Arthur and Marla, and, you know, being able to reach out to Marla at 7:30, 8 o'clock at night and say, hey, by the way, I got a question. So that was invaluable for me because I am a big relationship person about developing relationships and making sure that those things are what's valuable in a relationship. And I've also done work. I've done many catering jobs for PIDC. So for me to continue to work with them and then to be able to refer other people to PIDC and say, hey, this is what they did for me. That was just a great experience all around. I have hands down great things to say about PIDC.
Great. Thank you for that noteworthy response, David. Now, for question number 2, this is actually for Arthur and Earl. What steps would you tell someone to take in preparation for the loan process? I guess we'll start with Earl or Arthur, with whoever.
Go ahead, Arthur, you were about to
Sure. Okay. Yeah, I think before any of that, we jump into documents. Well, I want to say first, Maria and David, thank you. I think you really highlighted some of the, reasons why I love working for PIDC. I've been here for about 5 years now. And it's not, yes, we go through a lot of deals and transactions, but we also are, we take time on the harder ones, on the ones that we want to build a relationship with, the ones we see that it's truly more promising and it has a big impact on the community. I think that's what makes PIDC, also other CDFIs too, do that as well. But the time you spend on each application is, it does take a long time. So that's why I want to say, number one is in terms of like preparing for a loan, you have to prepare early. Preparing for applying for a loan is just don't think that, we always say that it takes 30 to 45 days. That's kind of like, our typical message, but there's usually going to be some bumps in the road, especially these days with COVID, where 2020 was a big loss for a lot of business owners and real estate developers too for their year. And 2021 is like a big recovery year. So I think that's probably a big part of it is just what is the story, like going back to the earlier part of the webinar is kind of what was your pivot? Like did you pivot? And how significant was it for your business? How has it truly changed your nature of your business? And now what are you doing in the future so that, God forbid this happens again or some other thing happens where we have to close down the economy? Like, are you prepared again? So that's like, I think that's one big question we're always asking our business owners is, have you come out stronger? Have you come out more, resilient and just more just, thinking about your process of your business, not just about sales and the numbers. But yeah, so I think applying for, going back to the original question, applying for a loan is really just putting all your documents together and not only just like sending it to us, but also going through it yourself. And like what David was saying, like understand what's on your, for example, what's on your credit report. You should be checking that at least once a year. The federal government allows us to do that once a year for free. I think it's called annualcreditreport.com. I used to do that every year, just to make sure that, because my identity has been stolen before. I've kind of been slacking lately, but it's something that we should all be doing because it's free, and just make sure that all the accounts in your credit report you know about. And then if there's judgments there, mispayments, things like that, you should be aware of it because it will come up on when we have to talk about the loan application. We usually go back maybe at most 7 to 10 years, but anything that's like in the past year or two at mispayments, it's probably gonna be related to COVID and like the impact of how the economy had to shut down, which is fine, but we just understand like, have you corrected that? Because now it's we're slowly getting past that. How have you prepared yourself so that it no longer happens again? Yeah, I think I'll just stop there. I'll let Earl speak, but I guess a big part of it is just being prepared and explaining kind of the story now of emerging from the pandemic.
Yeah, and what's important from my perspective is for people to really understand what their needs are and what impact the finances is going to have on their business. And when we talk about understanding what your needs are, in a lot of instances when small businesses come in to borrow, especially for the first time, they're trying to construct a story that will get them the loan, no matter whether it's the truth, whether it really reflects what they're going to do. They are focused on creating a plan or a scenario for the lender. But what we try to get them to understand is the most important person that has to understand what's going on with the business and what the plans are and the needs are is the business owner, because you are the person that has all of the risk. So understanding what the loan is for, how you're going to use the money, and the impact on your business. The two things that the lender is interested in is your ability to pay and your willingness to pay. So having a clear idea of what the cash flow needs, what cash flow is in that business, is there sufficient profit and cash to meet that ability to pay criteria, and then being familiar with your history of paying, your credit reports, your credit issues, how you've dealt with other people that you've had those kinds of relationships with. And the other thing that's often overlooked that I suggest that people do even before they come in for financing is build a relationship with a lender. It doesn't cost you anything to do that. There are all kinds of lenders that are out there. Find your CDFI or two to just start building a relationship with. Find out who the people are that are making certain kinds of decisions or that can lend you assistance. Have them understand what it is that you're doing as a business owner and what your business is about. And have periodic check-ins, just talk with that person or talk with that institution. That goes a long way in terms of a business owner getting the kind of need in a timely fashion that he needs to for his financing for his business.
Okay, great. Thank you for that crystal clear answer. The next question is actually for David. What was the loan used for? I guess he must be.
He's sitting in a shop, so
putting together a platter.
yeah, exactly.
I'm about to
Thanks,
go
Maria.
live with him. Getting hungry.
Okay. I'm back. So my loan was actually used for the purchase of this commercial property that I'm at now, which is 1540 Wadsworth Avenue. I had been on Ridge Avenue for 13 years. And the interesting thing about it now that I look back, I actually had a great enough credit score when I moved from my first place on Ridge Avenue. I'm sorry, my first place on Lehigh Avenue to Ridge Avenue. I was in the high 600s, but I wasn't thinking purchase. I was just thinking, okay, I've got to move one location and move to another. Over the course of spending 13 years on Ridge Avenue and, being in a property that was something that Donald Trump referred to as some third world nation companies. That was third world nation countries last year. I basically was in a property that was, the landlord didn't do anything. And there were so many structural defects, even outside with the concrete and, other things other than mice were coming into my building. And I used the loan to purchase the building, and I didn't know that I could get a loan, but I went to my accountant and I was like, I believe I can do better than this. And she was like, I said, can we afford to buy a building? And she was like, with the numbers you're doing, hell yeah. So I was very happy to see that. I was very happy to see the PIDC brought me in, sat me down, talked about it, went through all of the things that I needed to clean up, that I needed to straighten out. And here I am today, and just in a better financial situation now than I was actually prior to COVID.
Great. So for question number 4, we're going to ask Maria, what do you currently have prospective expansion projects requiring a loan?
Oh boy, we have projects. Mosaic's in a very exciting place right now. You know, we have certainly a lot of projects going on and a lot of prospective things that we're sort of have our, you know, putting our finger out there to say this is something we'd be interested in, and hoping, you know, responding to RFPs every day, and, you know, getting a lot of outreach. It's definitely a growth moment for us, and so there's a lot of things. I'd say at the 4 is housing. There's a series of multifamily projects that aren't, you know, necessarily fit for PIDC that are on our radar. There is a mixed use, some with commercial on the ground floor, where I think we'll use low-income housing tax credits, and PIDC could be a partner there. And we're always very interested in the new market tax credit portion of, you know, PIDC as a CDE on the new market tax credit side, because those fit really well with the mission side of what we're doing, and, you know, help us accomplish the goals of, you know, community driven, sometimes challenging neighborhoods where we want to work, and the economics aren't always great. And so PIDC can lean in there with us and fill those moments.
Great. Thank you for your input. Next question. I think I'm going to pass the baton to John.
And just jumping off of that before we get to the next question. So what are some of the specifics that, like Maria was talking about, that a small business owner might find working with PIDC?
Yeah, I mean, for me, PIDC is creative in the way they think. And sometimes, you know, I'm already in a deal where I'm working with PIDC and another lender, and we hit a road bump along the way. And it is consistently PIDC that I can pick up the phone and say, can you talk through this with me? Because, you know, it didn't unfold exactly as we'd laid it out when we wrote the sources and uses and wrote the capital stack. And, you know, there's some things going on that I can't quite, you know, that I want to talk through. And PIDC is really good at that, because not only are they the lender, but they've done this a million times before, or however many times before. But I find their team is open to thinking outside the box, and they may not be able to say, well, you know, this is the answer and I'm going to do it for you, or however, but they're going to think through with you at a level, at a deeper level. And so I've always appreciated that, because these are, I mean, the projects that we do are complicated. They're not straightforward. They're not, you know, they have a thin margin and a high level of risk. And so to be on a team with somebody who's going to try to be creative when there's a problem, rather than just kind of close the door and be like, yeah, that's your problem. That's been really important for us, and for the projects that we're doing. To get to the finish line, you need to be a partner with that lender, not necessarily, you know, like any other way. It's just not going to work. And that's been really important for us anyway.
That's been my experience as well. Maria, you just made me think about something. So the day that I went to the day that I went to closing, which was November 15th, 2019, there was a road bump. I don't remember exactly what it was, but I knew one of the things that I did was, you know, when you're going through closing and you're back and forth, and they tell you 1 minute that you got to bring $1,000 to close, and the next minute is $1,500, the next minute is down to $750. So I was back and forth with about 8 emails. So I had gone to the bank to get my cashier's check, and there was something that came up. I don't really remember what it was, but they were able to figure out 30 minutes before I went to closing how it was that they could bring it to resolve, that it would not affect me or me not getting my loan closed. So they were really, really good about that. And one of the other things, I just wanted to go back a little bit. One of the things that I learned is while I knew that there was a LexisNexis credit report, it's kind of like the regular credit report on steroids. So I knew about it, I had heard about it, but I never had one pulled. So to now be able to anytime be able to go to that LexisNexis report and be able to see what's viewed, and then also work on getting whatever things that were not resolved. PIDC helped me to realize that there's some additional things that I could work on.
It's more than just lending, and there's a whole bunch of resources that you can draw from. So talking to the lender assistance side, and Arthur and Earl, what do you look for in a small business that you provide, or small businesses you provide loans for?
I'll let you go first.
Well, what we look for is, of course, what lending is about in terms of people having the ability to pay and willingness to pay. But on the front end of that, one of the things that Melissa talked about in the previous panel is having the right kind of culture in your organization to do lending in this space. And in that culture, you have to be willing to meet people where they are in terms of their understanding of what this whole lending thing is about their understanding of business and business financials. David has related very well the things that he didn't know as a borrower. But what you find is, if you relate to people what it's all about, a lot of times they find themselves in a position to get what they figured that they couldn't get. So with that said, what we're looking for on the front end is that person that has a willingness to allow us to help them. They don't know everything. They don't want to have to present themselves as knowing everything, but allowing us to help them move in this process so they can get what they need. I had a young man here recently. He had been in business about 6 or 7 years, didn't have a lot of the historical financials, did not have the current financials, a lot of the history and plans about his business. He didn't have any of that. But when we met him where he was and started to work with him, he allowed us to do that. And what we found was the man had a business that was making profit. He had a credit score close to 800, and he was able to get a $100,000 loan. So this whole thing about the culture of your organization embracing people, as lenders, we often talk about, well, what you got to do to meet my criteria. And that's where our conversation starts and ends. But what we try to do is realize that people have a real discomfort area and a knowledge gap about how this works. And what we try to do is put them in a position where they can bring forth the things that they need to get what they need to do for their business. And one of the key things is helping people understand. A lot of people don't understand, well, why do you need financial information? Why you gotta know my credit history, stuff like that. And what I say to them, as lenders, we have to establish your ability to pay and willingness to pay. And the difference is, you have a store and a person comes in and wants to buy potato chips. Potato chips cost $1.49, and you let them know that, and they pull a $5 bill out of their pocket. So you know they have the ability to pay. Now the willingness to pay is, will they put the $5 on the counter and give it to you for the potato chips? That's in your business. In our business as a lender, we only get a promise to pay. you get the product, which is our money, before you make any payments. We only get a promise to pay. So that's why we have to establish your ability to pay and your willingness to pay. And the way we do that is by looking at your financials, your historicals, what kind of money you're making. Are you making profit? That tells us that you have the ability to pay. And when we look at your credit history and what you've done with others, that establishes your willingness to pay. You put it to those, to put it to people in those terms, they understand it a lot better, and they're a lot more cooperative in terms of getting you the information you need to help them.
I just wanted to remind our audience, if you do have questions, place them in the chat. And as we have our exchange, we will address them.
Arthur, did you have anything to add to that? Yeah.
Yeah, and to add to Earl's point, I also like the way the paradigm I look at through is the lenses is through the 3 Ps, like people, process, and product. So I think what Earl's talking about, like people, like what's their character, right? Like are they, looking at their credit report, understanding their history of borrowing money, but also understanding their attitude, or what do they bring with them? Are they willing to work with us? Are they willing to listen to what we have to say? Or they just, do they just want our money and want to run away? There's trust. I think it's trust that has to be built between ourselves and to the borrower. And yeah, at the end of the day, that's the exercise we're really going through. Is there enough trust there that we're building on? And will you have a willingness to pay if things go south? Like, a lot of these loans it's a 5-year loan. If it's a commercial mortgage, it's a 15-year loan. These are like really long-term relationships. So, we're gonna have to stay in touch for a very long time. If we get a sense that they don't want to work with us, or they're not willing to listen to what we have to say, or be in touch when things go south, or when their times get bad and times get tough. I mean, that's like, those are the things we're trying to pick up on early in the process before we give you, it could be up to like 700 for PIDC, up to close to $1 million. So that's really, it's like a trust building process. Also add like the process, like your business process, like how good are you with, like for example, we ask for, yes, it's easy to make sales, but we ask for your accounts receivable aging report, for example. Like, how good are you? It's easy to make a sale, but how good are you actually collecting that money? Is it taking you, same day, with some 5 days, 10 days, a month, 2 months, 3 months? That's a different story. If it's taking you that long to actually collect payment from your customers. So what's your billing process like? What's your invoicing process like? How often do you talk to your accountant, your bookkeeper? Is it once a year when you do taxes? Or is it a more quarterly or best, often monthly exercise? You're actually understanding what your profit margins are every month. It's especially for seasonal businesses, that's really important, because they make most of their money during, say the summer months, and the winter months are going to be really lean. So you have to be paying attention to your margins on a monthly basis. And then lastly, are you selling a product that people really want, or a service people really want? Is it unique? Does it have something that has a lasting ability to your customer, that they'll want to come back for it more and more? Or is it something that is antiquated, that some people want, but the market share is declining? So because PIDC, we work with all types of businesses, but ideally we want to see a business that's slowly growing, that has something in the marketplace that people really want, that it's both a product and a service that people really want, and there's going to be a lot of repeated sales, recurring revenue. So we want to see some stability. So that's usually why we want to see at least 2 or 3 years worth of revenues and profitability. Yeah, and also want to see, like, I think it's not just about the numbers. What are you doing? What are you doing to continue your education? Like example, like for COVID, like did you already have an e-commerce web store, online web store before COVID, or do you have one now? You know, a lot of businesses don't even have like they might have a simple website, but do they really have a way to sell their products online? You know, is that a bigger portion of their business now, or is that keeping that small? You know, how are they adapting to the times? How are they really like listening to the customer? We also have a lot of clients that attend like trade shows to get a lot of the kind of industry knowledge of what do big purchasers like grocery stores, like Whole Foods and things like that, what are they looking for now? And are the businesses adapting to those needs? So it's a lot of those like kind of softer skill sets that we look for too, that you know, even though, like to Earl's point, like maybe the profitability is not there, but if they are, you can show that they're adapting, they're willing to learn, and they're actually learning to improve their products. You know, we still might go on this journey with them and take that chance, as long as they show that they're investing in their business. And even though like the profitability might not be there today, there is probably a good chance it'll be there in the future. So sometimes that's the gamble. We have, the risk we take. You know, and we learn like this is, lending money is a riskier process. It's never 100% safe. It's not safe. It's never a safe transaction. There's always going to be ability to lose money in terms of repayment. So it's a really how do we mitigate as many risks as possible? And that's just through all these different criteria I was talking about.
Yeah. Which leads us to the next question. It's kind of taking a step back, but from a borrower's side, and actually from all of you, because you're on both sides of it. When should someone actually consider a loan? I'll open that up to any of you.
I mean, I'll start quickly. I think it's just building those relationships first. The way I like to see people interact with, at least me, because I'm usually the first person they talk to at PIDC, is they shop it around, or they at least, the last question they ask is to apply for a loan. They ask, who's PIDC? What do you guys do? How long have you been around? They get to know us more first before they actually apply for a loan. I think it's always a good time to look for a loan when you don't need it, right? When you have a really healthy credit report, your credit score's 800 or over 800 sometimes. You have a lot of cash in the bank. You have your credit report's really strong. What else is your business is doing really well? Like that's like the best time to apply for a loan. Unfortunately, the worst time is when you need it the most.
Yeah.
Which is like, it's counterintuitive, but that's like when you're losing money and when like behind on rent, when you're, let's say employees are leaving you or something because you're not paying them enough. Like that's unfortunately the worst time to apply. But that's when you need it the most though. So I think that's why it has to be early. You have to kind of build those relationships early, even though you might not need it yet, so that like when the time comes and things are going to shift in terms of maybe it's a new project coming down the pipeline, or maybe there's another pandemic in the future. I don't know. Like, it's better to build a relationship beforehand, and so that you have someone to talk to. So maybe like hopefully we have a professional relationship already. So it's an easier ask. It's much more it's a smoother process.
Yeah, I think to Arthur's point, we try to anticipate needing the loan, right? So like in early stage, when you're planning your project, you're writing your budget, you're thinking through, where different, grants and equity that you already have, and you're trying to anticipate when you're going to need a gap filler so that you're ready at the time. It could be however far in advance, but you should be creating like a monthly projection so that you can see, well, there's going to be a squeeze in month 11, and I think I'm going to need that. And so let's have the conversations now knowing that I can see that coming, right? Now, I mean, that's not always possible, but you know, you want to be as prepared as you can be and as thoughtful in projecting those things so that you're not caught off guard. Like you can see, if you're looking deeply enough, you know, you can kind of anticipate when in the trajectory of a project, you know, there's going to be a shortfall. And so the more you can lean into those projections and just be honest about, you know, where you're going to be, the more prepared you'll be and the more conversations you can have. And, you know, you might not need the loan right this minute. And that's the best time to think, well, I'm going to need a loan 11 months from now. Because it is time consuming. It's never 30 to 45 days.
We're actually running toward the end of our time. I want to get to the last question because it goes directly to Earl and Arthur. And we've also heard from Maria and David about this. What distinguishes the loan programs of PIDC and Entrepreneur Works? Go ahead.
Yeah. Well, with Entrepreneur Works, we are a micro lender. Our loans range from $500 to $50,000. We don't do, you know, real estate or real estate speculation type lending. We do some startups, and we do startups in terms of lending up to $15,000. We have a couple of loan products that are targeted at certain populations like women, where there's reduced interest rate for them borrowing. So yeah, I guess those are the distinguishing features about us. How we're different from the PIDC, we aren't as large, don't do as big a deal as PIDC or the diversity of deals they do. Yeah.
Yeah, I would say like we can't, it's rare that we work with startups. And that's, I think, one of our weak spots. And that's what we have partnerships with, like, you know, Entrepreneur Works, the Enterprise Center where I used to work, other CDFIs. The nice thing to know is all CDFIs, we're all lenders. We're all slightly different. We have our own like sweet spots, I would say. And I think a lot of times most times the borrower doesn't know that. They just, you know, maybe like they do Google search, you're the first, you know, lender that shows up when they say look for a community lender. And I think that's the importance of this partnership, so we can refer deals to each other. And I think it's also a function of the funds we have access to. A lot of those funds kind of dictate who we can lend to, who we cannot lend to, and kind of what types of attributes we need to look for in these types of businesses, like, you know, like a number of years in the business, how much industries, it's usually doesn't say that, but if there's like construction involved, like some of our, we have some federal funds that say that if there's construction involved, any type of construction, no matter how small, it has to be prevailing wage. And that increases, you know, the construction costs, you know, significantly. So sometimes we're tied to those types of compliances. Yeah, but I think that's, so yeah, so I bet PIDC also has a separate real estate development team that works with developers like Mosaic. The commercial mortgage is something that we've only had for the past, I'd say, 3 or 4 years now. Not a lot of CDFIs have that, but I think that's something that more should have, because I think it's important for businesses as much as possible. As David knows, it's really beneficial for a business owner to own their property, especially when they do some improvements on it. They really keep it, make it up to code, bring up the code, and then they maintain it. They should own those improvements.
I think both of you have really talked about how that starting that relationship, as you talked about, is important to find out the fit, and also you're able to lead folks in a different direction if you don't fit with them. That's important. We only have a couple of minutes left, but I'm on an iPad, so I can't see what the chat is. I don't know if maybe
there haven't been
watching.
any questions in the chat. So I would like to just thank our amazing panel and our facilitators. Our panel has been Arthur Jimenez from PIDC, who serves as the Director of Business Development there, and Earl Board, who's the Director of Entrepreneurial Services from Entrepreneur Works. Our business owners have been Maria Sobir, who's a RA Senior VP of Development at Mosaic, and David Sins, who's the proprietor artist at Eatable Delights, and our wonderful facilitators, John Kaler, who is the president of Prospect Productions and a member of TBC Board, and Ron Williford, who is the president of Philadelphia Financial Consulting LLC and is the president of the TBC Board. I'm Pam Rich Wheeler with the Business Center, and this event, The Future Holds, What the Future Holds for Funding Entrepreneurs of Color, has been hosted by the Philadelphia Global Entrepreneurship Week Committee, which consists of the Philadelphia Department of Commerce, Community College of Philadelphia, Power Up Your Business, Temple, SBDC, NextFed, PIDC, SCORE, and the Business Center. And I hope that you all gain as much great information as I have. And I do see in the chat, love the panel, facilitators, and the topic, worth my investment of time. Love the ROI. Thank you all. So that's a great note to end on. And we thank you.
It's a pleasure, everyone.
Good day.
It's been a
Thank you.
pleasure.
Thank you so much.
Everyone.
Take care.
Have a good day.